Hi, and welcome back again to Tim Bigham's Big Time Options, Edges, and Hedges. Be taking a look today at Adobe ADBE, and is it finally time to maybe get a little bullish or maybe a little less bearish on Adobe in front of earnings as the stock hits multi-year lows? So let's jump in and take a look. We always like to use our fusion approach that combines fundamental, technical, and most importantly, IV analysis. So from a fundamental standpoint, here you can see, first of all, the earnings coming up Thursday, March 12th. You can see Adobe has beaten earnings the past 4 quarters fairly handily, not huge beats, but beats nonetheless, yet the stock has been cut basically in almost half in that time frame. Lower stock prices and better earnings lead to lower valuation multiples. Pulled off the 10-year price to sales ratio, you can see trading under 5x for the first time in the past decade. So certainly getting cheap on a price to sales basis. The PE ratio more widely followed, right? Under 16 now. That's the first time since late in 2011 briefly, which marked a significant low in the share. So certainly the stock not expensive from a valuation perspective. Further downside, right, with earnings coming in decently, I can't see much more multiple compression. Certainly everyone thinking that Adobe is done because of AI, but at this level, I think it's absolutely worth a nibble. As we also said, we like to take a look at technical analysis. So pulled off the chart here, you can see Adobe getting definitely oversold, 9-day RSI under 20, now starting to strengthen or hold that level at least a little. MACD got to the extremes, starting to look better. We always like to kind of wait for that curl, right? Wait for a little strength to show up. Bollinger percent B was negative, right? But now is clinging to positive territory. So starting to perhaps build a base here as the stock traded briefly below 263, now trading up around the 265 level. You can also see implied volatility, and this is due mostly to earnings, but also the big drubbing in the stock when it broke that major support at 330. We're now at 265, so you're seeing basically about a 20% pullback just from here. At the beginning of the year, right, the stock was almost at 500. Now we're almost cut in half at 250, even with those earnings beats, as we said. So high implied volatility means you can get further out of the money and get a same net credit, or stay the same distance, get a bigger net credit, or combine the two. So we elected to take advantage of that high implied volatility. And you can see here IV creeping up. I use 30-day IV because we're using about a 30-day option here. IV at the highest level since the last earnings, where you saw the normal vol crush, right? So you see the run up, the pump, and then the dump. You can see the short end actually moved higher from yesterday to the previous day, right? With yesterday IV improving on the short end. The rest of the curve stayed fairly flat. Current IV percentile at the 77th percentile, certainly well worth selling. And interesting enough, I pulled off a kind of 20-day, 52-week look average at a 25 delta call and put, right, the at the money IV. You can see trading at the highest IV level we've seen in the past 20 days. Wasn't long ago that 25 delta call and put both, right, were trading under that 35 level, basically in the low 30s. Now we're pushing towards 50, right? We're also seeing the put call differential, puts increasing a little bit more than the calls, right? The calls at a 47.4, put 47.7. Not huge amounts, but another sign that maybe some put protection is being put in place, normally a good contrarian side. So that's set up ideally for the trade, which is simply going out, selling the March 6th. So we're staying before expiration on March 12th. We want to avoid that, right? So we're selling the March 6th, eliminate that earnings rich, selling the 240 put, hedging by buying the 235 put, bringing in over 80 cents net credit, right? About 85 cents. I used 80 cents, right, for our example here. So you can make 80 bucks, right, for each time you sell this spread. Your max risk, it's a 5-point wide spread, and you're bringing in 80, so your risk is 420 if Adobe just goes to hell in a handbasket. So your return on risk, right over 19%, very nice return on risk. Downside cushion with Adobe closing right around 265. That 240 put has 25 points roughly of downside cushion, or just over 10%. So you can see Adobe, which has been absolutely taken out to the woodshed, as we said, another 10% downside until you get into trouble. We're taking advantage of that high IV, able to sell that 45ish, that almost 50 IV on the trade to position to be a buyer on even further weaknesses in Adobe. If not, you collect some very nice option premium. So hopefully identifies how we go about identifying trade opportunities using that fusion approach, combining fundamental, technical, and most importantly, IV analysis to structure trades that have a probabilistic edge. But at the end of the day, as we know, trading is all about probability, not certainty. So make sure you position size accordingly and make sure you get out when you need to. So until next time, as always, here's the good trading. Take care.